Hey fellow traders! If you are familiar with either technical or fundamental analysis, you may have already noticed that both approaches have their advantages and disadvantages. However, even the combination of these two methods might not be enough to close the gap between their drawbacks. For example, the fundamental analysis often completely ignores the technical markup, just like in this case. We can see that with the formation of the triangle pattern during the news publication, the price has broken out the lower and then out of the upper border. Thus, the price has completely ignored the boundaries of the formed triangle pattern. And the signals of the both methods generally don't coincide in time, which we can also see in this example. The breakout of the triangle pattern was expected to appear somewhere here, but this didn't happen. But what about sentiment analysis? This third type of analysis can be used alongside technical and fundamental. Now let's talk about how sentiment analysis can improve your trading. The classic head and shoulders pattern. If we are following the technical approach, we open a trade at the neck level and wait. But nope, the price is not following the expected direction. Instead, the stop loss closes our position. So why didn't the pattern work? Unfortunately, technical analysis won't tell you a thing about this. However, the sentiment approach can give you an answer. Let's take a look at what's happening during the pattern formation and how the market looked when the pattern was unfolding. For a quick assessment of market sentiment, let's take the current ratio indicator. It shows who currently dominates the market, buyers or sellers. Statistics are displayed based on the data from a number of the largest brokers. We can see that most of the traders are selling at the moment. And since the majority is usually wrong, it's just how market works. The market is most probably bullish and it's too early to look for short positions. This is the first signal that now isn't the right time to sell. Let's analyze the placements of the sellers along the price vertical using the OrderBook indicator. We can see that right before the formation of the right shoulder, sellers actively enter the market. The difference is significant compared to the left shoulder. In practice, it will be difficult for the price to break through this cluster. If we dive into conspiracies, there is no way such a huge amount of traders will be allowed to make money. If we have the market's nature in mind, however, we'll realize that this amount of sellers simply will not allow themselves to make money. Since once their trades become profitable, they will actively close these trades, thereby pushing the price back. All of the above suggests that the market has formed a trap for those who saw the head and shoulders. Perhaps in this case it would have been better to consider a scenario of this pattern's break and looking for a long position. Now let's take a look at the possible trade example. We open our long position at the neckline and set our take profit a bit above the expected head of the pattern. This is where we can see the clusters of the stop-loss orders using the StopLossClusters Indicator. It shows the levels where the most of the traders have placed their stop losses. These are the so-called pain levels of the crowd. The stop-loss clusters attract the price, so setting a take profit at this level increases your chances of a successful trade. There is a number of reasons for this, but we are mostly interested in the fact that the price gravitates toward them. Here is an example of how the price interacts with such clusters. So let's take another look at what happened. And the trade closes at take profit here. Do you want to see what it looks like in the case of a true head and shoulders pattern? Let's take a similar situation. Here is the head and shoulders pattern for a GBP/USD currency pair. Suppose we start to recognize a possible head and shoulders pattern somewhere here. The first thing that catches the eye is a reversal signal from the ProfitRation indicator. It is triggered when there is an extreme number of profit buyers or sellers in the market. Usually this is considered as a signal for a price reversal. Placing the crosshair of the order book over this point, we see that it's profit buyers. Let's compare the image in the order book on the left and right shoulders like we did last time. Do you see the difference? In this case, the traders haven't recognized the pattern and expect the update of the local maximum somewhere here. This confirms the possible scenario suggested by technical analysis, and it makes sense to consider a short position in order to break out the current low. Have you already noticed that the large stop-loss clusters is now at the bottom, that is at the neckline level? This is also another signal confirming the pattern is true. As you can see, sentiment analysis shows us a bit more than the technical approach. But this doesn't mean we should abandon either fundamental or technical methods. On the contrary, combining all three types of analysis will help you understand the market a lot better. In this video, we've shown you just a few analysis options using sentiment indicators. However, the idea behind all of them is about the same. Open a trade alongside a big player or market maker through the analysis of the market crowd. You can download all the indicators mentioned in this video by following the link in the description below and get a free trial for 7 days. We recommend using an automatic certified installer, or you can install the files manually as you can usually do in the MT4 terminal. But don't forget to copy all the files, since indicators use additional libraries. That's all for now. Thanks for watching and good luck in your trading journey.